Hey, good afternoon. It is Friday, 1:30. Here's your end of week recap for how these grain markets traded. First of all, let's start with soybeans here. And one of you mentioned to me that the last time I did a video, I failed to take the screen off of soybeans, and I really do apologize for that. So we're going to look at what this chart looks like and what we should hope to expect next week coming into the new week. All right. This is November beans. I'm going to flip this over to January here in just a second. Options expiration was today. First delivery day is next, or first notice day is next week. So big outside day up. Nice structure here with the corrective price channel to the downside, followed with a new developing channel on the ups established at today's low. So this becomes a really important level, right? 13.19, and then on Tuesday. Monday, Tuesday, we're sitting 13.34, 13.40. Soybeans need to get up and out of here. Let's move this to the January beans. Here we are, January beans daily chart. Almost identical structure, right? No differences to speak of. Volumes did start to pick up a little bit today on the up move. That's really to be expected on expiration with all the last minute rolls and things. So I wouldn't read too much into that. Everything here looks really pretty good. I got a little bit nervous yesterday down here at this low just because of expiration, but it looks today like we're ready to actually turn this thing for higher. So our bias is up on the soybean market. That's supported by a lot of things, right? Weather in South America, domestic crop size, domestic demand, lack of supply in Argentina, lack of adequate supplies in China. There's a lot of bullish underpinning fundamentals here on all of these markets that we don't want to be naive to just because price is putting us into difficult territory. So now let's look at corn. Corn really didn't perform poorly at all today. We came out of here Friday. We've had some follow through, but really there's no structural damage here on this chart with the exception of the breaking of this lower channel here, which we don't like to see have happen. I've left it here for your perspective. But anything above these lows right down in here is a go in our opinion on corn, and here is a solid reason why. Okay, I'm going to turn this to the weekly chart of December corn. That is a nice buy signal, and then if I put some more indicators on here, you're going to see lots of divergence action coming across the board here. So we have a little rally off the bottom and a little retracement on the stochastics. This looks good. We got the nice divergence on the RSI, force index. We have nice divergence here as well on the weekly chart. Things look good on corn. Let's jump out to March so you can see what that looks like as well. Here is your weekly chart of March. It doesn't look bad at all. Looks to be following a very similar structure. If we come down to the daily chart level, it looks good as well. It's not a buy yet because we haven't had enough turn, but we do have a nice little bullish engulfing day here and a move back up above this 507 level, and definitely a move back up into this territory, right, which is 30 cents away. I get that, but that can really accelerate these markets higher with as short as funds are. Remember, the situation in Mato Grosso, Brazil is becoming much more severe every waking moment, and the weather forecasts in that area are not turning wetter, they're actually turning drier. Now remember, that area, just Mato Grosso, the state of Mato Grosso in Brazil, is absolutely massive. It's the size of Nebraska, South Dakota, Iowa, Illinois, and a couple other states in the Corn Belt. So it's like our entire Corn Belt with a giant red dot on it from a dryness perspective as they're trying to plant the corn crop. So pay attention here, because if the market decides it wants to start pricing some of that stuff in, then it's going to go very, very quickly to the upside. So I don't want to be caught in a position here that's not nimble, that we can't benefit from higher prices because they could materialize really quickly, especially if our crop is a little bit on the light side, and our supply is down a little bit. our demand is up a little bit. It starts to rain and fill the Mississippi up, and Brazil is drying up. That's like a perfect storm. And add geopolitical tensions to that. It's just a perfect storm for higher prices. So I don't want to get caught. I don't want to get caught down here without that upside potential open, and definitely want to be cognizant that we could be wrong and this thing could fall out of bed too. I don't know what would drive that, but it could happen. So we want to be aware of it and not hurt anything if it goes lower. You know, wheat's a perfect example of what can happen, will happen, and it just continues to get pummeled to the downside. We started sliding Monday, Tuesday, Wednesday, Thursday, Friday here on this on this setup, and it just kept getting hammered, and nothing can salvage this market. So it just seems like all hope is lost here, right? I don't think so, because remember, we've been talking about divergences. And the thing about divergences is that they're super difficult to time because they can just keep repeating. But what we're seeing here is that we're seeing decreasing momentum and decreasing conviction behind the down moves. So at this point, we're just selling it because it's working. We're not selling it for any reason other than that. And when that coil releases or the rubber band that's stretched too tightly snaps, then these prices can snap really hard. And with as bullish as corn is starting to look and beans, I just do not see where wheat can go. So I am honestly looking and targeting an area back up into this $8.50 to $9 area for a move on Kansas City wheat. What time frame is a mystery. Let's look at next July, because I know that's front and center. You know, next July doesn't look bad from it looks exactly the same as the rest of the months. These big divergences in effect. We need to see a little bit of, obviously we need to see higher highs before we can do any victory dances. But this market seems to be ready to absolutely explode. We talked earlier in the week that we may need to jump down here and relieve the pressure from this consolidation zone. But I think we did that in a big way yesterday and today. And now we've kind of exhausted that. So I would look for all of these markets to rally in the next week or two ahead of any new reports. All right, that's 8 minutes. We will be with you all the time. You know, these geopolitical events, I think, are really, really important to these markets, but our markets just aren't responding to them yet. I don't think that's because we're naive to them or anything else. It's just not happened yet. So I think once traders turn their attention to what the real impact is here to the supply and demand and the balance sheets, that we're tighter than we think we were or than we thought we were, then up and away. So we're going to stay the course here and be super patient. A divergence like in wheat, where you just continue to have distinct higher lows on your indicators, is not a bearish phenomenon. These are repeat buy signals here that need to continuously be bought because the snapback is almost always worth it. All right, I'm going to not hammer that any harder than I have been. We're just going to stick with that for now. Hope you guys have a great weekend. Remember, there is risk trading futures and options, and you should only do so in light of your own financial condition. We will be back with you Monday and as needed every day next week, but for sure Monday, Wednesday, and Friday to keep you posted on how the markets are developing. Hope you guys have a great weekend. We'll talk to you Monday.